So in this question, we have tablet. Now, like most companies, they performed a physical inventory count on the last day of the year, right? And they determined that their ending inventory balance based on what was out in the warehouse was $202,000. Now, ultimately, we're given some other financial information to basically roll forward what we think ending inventory balance is per the perpetual system or the trial balance, right? And we know at the end of the day, when it comes to performing this physical inventory count, we need to determine whether variances exist between the physical count and the perpetual inventory listing, which should reconcile with the company's trial balances. So what makes this question difficult is that we need to first determine ending inventory using the financial information, and then we'll compare it to the inventory per the physical count, and then determine, okay, do we need to make an adjusting entry? And if we do, what would that entry be, right? So there's going to be 3 steps we need to perform here, and this is something very similar to what an accounting department would have to perform at the end of each year. So we'll go ahead and use the base method to prepare an inventory roll forward to calculate what ending inventory is per the financial statements, right? And this is unadjusted. So in step 1, we'll take beginning inventory of $276,000, add inventory purchases of $168,000, and that tells us cost of goods sold available for sale is going to be $444,000. And then we just need to subtract cost of goods sold of $239,000, and that tells us ending inventory per the perpetual or the financial statements would be $205,000. Now in step 2, this is where we compare it to the inventory per the physical inventory count, which was $202,000. So we take $202,000 minus inventory per the system, right, from the perpetual system, and that's $205,000. And that means we need an adjustment to inventory to reduce inventory by $3,000, right? Inventory is currently overstated by $3,000. Now, I know all the auditors are out there going, okay, $3,000, that's super immaterial, right? But this is not audit, and a company wants to have their financial statements be accurate, right? So even though it's only $3,000, they would still record an adjusting entry to true up their inventory balance. And since we need to decrease inventory, well, we are going to credit inventory for $3,000, and the offset is a debit to cost of goods sold for $3,000, right? So the correct journal entry would be a debit to cost of goods sold for $3,000 and credit inventory for $3,000. So this was a great question because not only did we have to go ahead and calculate ending inventory using the base method, we had to compare and determine whether inventory was overstated or understated based on the physical count, and then we also had to propose and record that adjusting entry, right? So lots of great information learned in this question, so make sure you fully understand the topics here.